Chapter 11. Apartment Investing. If everyone is moving forward together, then success takes care of itself. Henry Ford. I can remember back in my college days at the University of Alabama and the first time I moved off campus into an apartment. The complex was huge and strictly allocated for college students, with most of the units having 4 bedrooms and 2 bathrooms and a common living area and kitchen. The units were rented by room for $600 per room, which equated to $2,400 in rent per door in a complex that had 16 3-story, 12-unit buildings. This equated to a staggering $460,800 of income per month. At the time, I couldn't even imagine how many millions of dollars it would take to own a property of that size, and I never would have envisioned being able to own it. We all have limiting beliefs on what we can accomplish in life. It took many years to overcome those limiting beliefs when it came to money and investing. My prayer and goal for you is this chapter shows you the different ways you too can add an apartment investing into your portfolio, whether as an active or passive investor. It took me stepping out of my comfort zone and attending a multifamily investor conference to realize how attainable owning an apartment truly was. It also showed me the level of teamwork involved to be a successful multifamily investor. Apartment investing has more sophisticated underwriting techniques and more expenses due to the number of units and management considerations when executing a business plan. However, you can hire, partner, or outsource those areas where you aren't strongest to properly manage the apartment. Essentially, buying an apartment is nothing more than buying and operating a business. Let's look at a great multifamily investor, Mr. Ray Reyes, who transitioned from retiring as a lieutenant colonel after serving 28 years in the Army to become a full-time multifamily real estate investor. Retired Army officer to full-time multifamily investor. I had the pleasure of sitting down with Ray when visiting Orlando while putting my book together. I met Ray a year earlier at a multifamily conference, and we routinely ran into each other at virtual meetups. As a second lieutenant, like so many real estate investors, Ray was impacted by reading Robert Kiyosaki's Rich Dad, Poor Dad, and it changed his entire mindset about money and investing. Early on, he bought a few single-family homes, but realized he was impacted by the inability to make progress when he wasn't physically present. Ray was another long-distance investor and even bought single-family rentals from overseas. But he realized the one flaw with single-family rental properties. If you're looking to generate a large amount of passive income, you would need to buy a lot of good deals, and finding good deals can take a lot of time. In the military, depending on your specific job or career field, you may be stationed overseas for multiple years at a time, or even deployed in a war zone for 9 to 12 months straight. Your single-family rentals require you to have a property manager to manage your portfolio. You will need to lean on them to show the property to potential residents, hire contractors to make repairs when things break, and most importantly, collect rent. Additionally, your revenue or income is derived from a single-family asset that generates zero income when vacant. Knowing this, Ray pivoted to investing passively in both multifamily investments using his self-directed IRA and through private lending to hard money lenders. When you compare the multifamily aspect to single-family, nothing beats the scale of multifamily on the residential side. For me, it's more of a time aspect. It takes a certain amount of time to go through an acquisition. A multifamily acquisition takes maybe twice as long as a single family does, but you're going from 1 unit to 4 units, or from anywhere from 50 to 100 units plus. So, it was just a matter of trying to figure out how fast I wanted to get somewhere, and single-family investing was just going to be too slow. Ray is right. Syndication provides more economy of scale and opportunities to grow your wealth without being hands-on for it is to be successful. Partnering with knowledgeable apartment operators lowers your risk and allows you to invest in large deals that you wouldn't be able to typically afford if you tried to invest in them alone. You can participate as a limited partner or private investor with no operational responsibility. However, as with all good syndicators, we keep our investors informed and send out monthly or quarterly newsletters with updates on our business plan execution. We ensure our investors stay up to date on the overall performance of the projects and the performance of our property management team, so they aren't left guessing on how their asset is performing. As I mentioned, Ray is a full-time multifamily syndicator and operator focusing on value-add multifamily properties across the Southeast U.S. Currently, his company has acquired 401 total units with a valuation of over $28 million. I asked Ray if he could go back to when he was 18 years old. What would be his advice for himself? I would say at the very least, you need some level of preparation for yourself, and certainly, you need to have some money. If I started saving just a little bit earlier on, it would have been useful and would have helped with the progression. Do something to prepare yourself. In multifamily syndication, you can be part of a team that has something to offer, and you don't want to be the one person trying to jump into a team, but you don't have the skill set to at least be in that space. You don't have to be the smartest or the best, but bring some individual focus and consider putting more money away as you go. Since I didn't do it, and I know a lot of other people don't either. Apartment investing metrics. So, I know you are probably wondering what makes a good apartment deal. Well, it depends. It depends on your strategy and investing goals. Some apartment syndications plan for as short as a 2-year hold period. Some may go as far out as 7 to 10 years. Or you may want to buy an apartment and keep it forever. Every apartment deal is different, but most offerings advertise anywhere from 6 to 10% cash-on-cash return a year with a target internal rate of return, IRR, from 15 to 20%. As a benchmark, a 20% IRR essentially doubles your principal investment in 5 years. Most syndicators focus on value-add apartment deals where the current owner has deferred maintenance at the property and hasn't kept rents at the market rate. Coincidentally, it becomes hard to charge premium rents if the property hasn't been renovated over time. There lies the opportunity to buy an apartment at a discount to execute a business plan to renovate units over a set period and increase the rents as the units are transitioned. It seems simple enough, but every apartment isn't the same. One of the primary variables that drive asset price, or capitalization, cap, rate for a market is the location. Cap rate is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. Cap rate is based on the net income the property is expected to generate and is calculated by dividing net operating income by the property asset value. The location determination is driven by future projections for job and population growth in the local economy and surrounding areas, along with crime statistics, school ratings, access to major transportation arteries, etc. One of the current trends that will be with us for at least the next few years is the mass baby boomer migration. We are seeing thousands of baby boomers relocate to the Southeast United States for retirement. Additionally, many people are escaping high-income tax states such as California, Illinois, and New York for states such as Phoenix, Florida, and North Carolina. The deal I never knew we could do. I referenced our first apartment deal a few times in the earlier chapters to amplify several different concepts. Real estate investing is a continuous journey where success evolves as you grow in knowledge and experience. I didn't venture into multifamily until 2020, after over a decade after buying my first single-family home. I knew apartments had many benefits and economies of scale, but I was so focused on single-family properties that I never took the time to see how close I was to make the transition. It didn't hit me until I attended a multifamily investing seminar in Orlando, Florida, back in October 2019. I try to attend at least 2 professional real estate investing events or seminars every year. Unfortunately, in May 2019, I tore my ACL in my left knee, which had to be surgically repaired. All my summer plans were altered, forcing me to miss my scheduled events. So, after a summer full of physical therapy and rehab, I was excited to find a real estate event coming up in Orlando, Florida, where my sister lives. So, we made a family trip out of it. I went to my seminar in the day while the family hung out and enjoyed each other. The event was life-changing. There were hundreds of apartment syndicators, operators, and private investors from all over the U.S. with all levels of expertise represented. Additionally, a couple dozen well-known syndicators and operators gave presentations across the 2-day event. A few of them I had the pleasure of interviewing for this book. Some guys had portfolios of apartments in the thousands of units. Some had quit full-time jobs making 6 figures, and others were operating part-time so they could eventually leave their day jobs. One of the immediate trends that stood out to me was the emphasis on team building to be successful. I left that conference with new inspiration and a vision for my investing journey. My new goal was to purchase our first multifamily property within the next year. Who would have known I would underwrite and submit my letter of intent, LOI, to purchase our first multifamily in less than 45 days in December 2019. I found the deal while searching on the MLS for the sales price of a vacant commercial lot behind our duplex as we prepared for its refinance appraisal. The apartment was owned by 2 older couples, with both owning other businesses while eyeing retirement. The apartment was listed for $1,350,000 and on the market for over 90 days at that point. I underwrote the deal and submitted an LOI for $1 million, which was my first 7-figure offer ever. I would walk the property a month later, and it would not be until early March before we would get it under contract. We closed in June 2020 in the middle of the COVID-19 pandemic. My wife and I decided to manage the property ourselves for 5 months since we already had orders to relocate back to the Northern Virginia area before Christmas. My mindset was to gain valuable experience managing the property to assist with gaining more insight into operations to better manage the property management companies on our future apartment deals. It was a great learning experience as I worked directly with other residents as we all navigated COVID-19 and maintained some type of normalcy. I have heard horror stories from other investors about how their residents banned against them and stopped paying rent due to the eviction moratorium. We were blessed not to have to experience those issues. However, we did have a couple of residents lose their job during the pandemic and struggled to keep current on payments. But from day one, we let our residents know we would work with them however we could, so we all could get through the pandemic together. At the end of the day, our residents are part of our team, and one could argue the most important part. Our mission is to provide clean, quality, and affordable housing for our residents. From day one, we demonstrated this by catching up on deferred maintenance and making necessary repairs to improve our residents' quality of life. One of the unique parts of our apartment purchase was the fact of us taking over an active insurance claim for 4 of the units damaged by Hurricane Michael back in October 2018. This allowed us to not have to worry about having additionally $50,000 for renovation. Unfortunately, it took 11 months before we settled with the insurance agency on the cost of the renovations. It was a hot mess that led to some of the seller's motivation. The short story is the owners signed an assignment of benefits and trusted a contractor who mismanaged the renovation project. The site lead quit on the job, taking all the historical documents, leaving his company owner in a bad spot. During this time frame, the on-site contractor demolished and removed a lot of cabinetry and flooring before the insurance company had an opportunity to come out to take pictures and officially assess the damage. Subsequently, the insurance company had to hire third-party engineers to assess the damage and generate reports for the field adjusters in order to complete their final report. Fortunately, it all worked out in our favor to have the claim paid out. Once we renovate the 4 units and return the property to 100% occupancy, we will perform a cash-out refinance into a long-term low, fixed-rate loan. We spoke back in Chapter 8 about inflation. In our business plan, before purchase, we estimated rents at $850 a month. With inflation and a shortage of rentals, in June 2021, our market resided at $900 a month. Our estimated monthly income will be around $15,000 per month, with monthly cash flow after expenses and debt services, mortgage payment, of about $5,000. The World Citizen Investor. Next, I want to share the story of a phenomenal individual and mentor I look up to, Mr. Maurice Philogene. I met Maurice through networking and attending different meetup events. He is an authentic human being focused on being the greatest version of himself while assisting others in achieving their dreams. His family is originally from Haiti, and he was born in New York and raised in Boston. After attending the University of Virginia, majoring in engineering while playing football, and participating in Air Force ROTC, he ended up in the D.C. area working for a consulting firm where he still works today. He recently retired from the U.S. Air Force after a 22-year career. Fortunately, the year he graduated, too many officers graduated nationwide, so he went into the Guard Reserve since his consulting firm offered him $42,000 a year, and the Air Force would only start him as a second lieutenant at $24,000 a year. He ended up as a federal agent working in the Air Force Office of Special Investigations, essentially working 2 careers. In 2002, he jumped into real estate after buying a place to live, which was the beginning of the boom cycle in the 2000s. Over the next 6 years, he would buy 35 single-family homes he self-managed. The beautiful thing that ended up happening was I learned over time that if I paid off these single-family homes, I would create passive income, and that passive income would be greater than the salary at my firm, and I wanted freedom. The reason I did it was because I wanted to control my time. It was never a money thing. It was always about controlling my time, so I could go do those things that you and I just talked about, which was traveling around the world to experience life the way I wanted. That's kind of how the business track started. After continued success in single-family investing, Maurice made the transition to multifamily in 2015. It wasn't because I was trying to become this massive company. It was because I stopped growing as a person. I was pressing repeat for 14 years, and I'm grateful that I did it. We're pressing repeat for 14 years on buying single-family residents, mostly condos and taking revenue from the military, revenue from my consulting firm, revenue from rents and paying off the first one, and then doing it again, paying off the second one. And this snowball effect happened to the point where I had 18 paid off places. So I was fine financially, but I wasn't challenged by any of that. So Maurice went into a real estate investment program and got a mentor. It took him about 2 years to break through his internal limiting beliefs that he could be successful in multifamily investing. He did his first deal, which ended up being a syndication. Fast forward to today, 30 plus deals later, he is helping other people get to the 5 freedoms his business coach taught him: financial freedom, time freedom, geographic freedom, freedom of purpose, and freedom of relationships. So, I wanted those 5 freedoms. What I'm doing now, by working with investors who are trying to get into real estate, it's not that they are necessarily trying to become millionaires and billionaires. It's that they're trying to have the lifestyle that they think millionaires and billionaires have. It's just a bit of time, freedom, and the ability to unplug from the 9-to-5 rat race, not get caught up in the titles and ranks, and compete with your peers. His company, Quattro Capital, established in 2019 with 3 other partners, has grown exceptionally. They have purchased over 18 apartment complexes across 9 different states, totaling over $100 million in 2021 alone. He also sponsors aspiring investors, and thus far, through his mentorship, he assisted new investors in closing 7 complexes and parks over the past 2 years. Lastly, Maurice has been blessed to travel to over 96 countries throughout his life journey and provide lasting impact across the globe. From TV star to private equity fund manager. I'll end this chapter on apartments by finishing the story about Dave Seymour after landing his star role on A&E's Flipping Boston. The TV show opened up a lot of doors for me. The doors that most guys and girls would knock on, and they wouldn't get an answer. For me, the TV show was the key, and if you put that key in the right door, it can open a lot more opportunities. It was national exposure on the Today Show, Rachel Ray, Squawk Box, and CNBC, since people wanted to hear my opinion, which always cracked me up. You're asking me about these big, deep, business-oriented questions, and 2 years ago, I was helping save heroin addicts who had overdosed. For me, I was always present and appreciative of the gifts that have been given to me. So I never squandered them with stupidity, and I sought to follow good people. Dave built a portfolio of cash-flowing real estate the entire time he was flipping houses on the TV show. Once he dialed it in and figured out the cash flow game, that's when things really began to accelerate for him. He also spent a lot of time in the lending business for real estate through hard money lending coupled with some private lending. It was a great business model and continues to be if I like a deal personally. When I liquidated everything and looked at the landscape that has been created with COVID, the lending business was out of business in approximately 3 days because Wall Street stopped buying at no origination. It was a crazy time. From there, Dave transitioned and reconnected with Walter Novicki, who has been investing in real estate since 1986. He is a fantastic individual, an unbelievable friend and partner. When it hits the fan, in any scenario, you want Walter by your side. He and I met in the education space we were teaching together with a national company, and we were the older guys on the road in our early 50s. We were hanging out with the kids who were being stupid at night. It was good, but we found there were a lot of commonalities and trust between us. So we launched Freedom Venture Investments, a private equity fund company. As of mid-2021, they were in the process of wrapping up a $100 million raise to buy multifamily assets in the Gulf Coast region of Florida, which is what his partner Walter has been doing for over 25 years. When COVID-19 came along and kicked everybody in the teeth, as Dave so eloquently stated, they saw the coming opportunity to assist amateur apartment investors facing challenges due to eviction moratoriums and not having necessary reserves to run the properties effectively. Most people didn't have proper property management and are experiencing higher than normal vacancies coupled with low rents. They only deal with accredited investors, individuals whose income is $200,000 a year or more as individual or $300,000 as a family unit or $1 million in net worth as determined by the SEC. Becoming an accredited investor is a simple process with your accountant or attorney signing off your accreditation. Dave discussed obtaining a letter recently for an upcoming investment he was making. I just got an accredited letter for myself for an investment I'm making with one of the New England Patriot players who have a new headphone business. I like his business, and I get an opportunity to hang around NFL players. So, for $50,000, I'll take a seat at the table and make a couple of bucks on these headphones, but being accredited gets you some exposure to investments that most other folks don't receive. However, the minimum investment in our fund is $100,000, with most of our investor conversations centered around $250,000 to $500,000. It's a good business, and I'm very proud that Walter and I have never lost one dime of investor capital in over 25 years of our careers. It's because we're probably the most conservative mothers on the face of the earth, because we're now working with other people's retirement dreams and other people's children's college savings. We take it very seriously. I want to relate to my investors, and I don't take a dime into my fund until they talk to me first. I want to meet my investors and know what their goals are to make sure we're aligned. I'll decline if they don't align with our family values. Our ideal investor is somebody who wants to come and play in the real estate sandbox, have fun, and get a fantastic return along the way. Dave is 100% right about the faith and trust investors place with the apartment syndicator's ability to deliver the promised returns. It's a serious business, but a rewarding business as you meet more investors and hear their stories and dreams. As we move into the future, with the aging of baby boomers and the increasing trend of millennials choosing to rent more, apartment investors will continue to beat the stock market and secure great cash flow and appreciation in the future. Implementation. Investing in apartments is a whole new world for those who aren't ingrained in it daily. But at the same time, it's no more than multiple small single-family homes co-located. As with any business, you will only be as good as your employees or team members. Have you considered or are you interested in investing in apartments passively or actively as a syndicator? If not, you should, because it's one of the best cash-flowing, tax-advantage assets, period. However, it is important to choose the right general partner or investor team to align with before investing. There are many 8- and 9-figure super syndication teams, but some great. Smaller syndication teams only focus on certain markets and have a lower investment minimum. At the end of the day, you want to align yourself with a team that has the same values as yourself. Therefore, I align myself with other syndicators like Jerome, Maurice, John, Ray, and Dave, who make their investors priority number one. We recognize the sacred responsibility that comes with managing millions of dollars on behalf of our investors. I encourage you to seek out more information on multifamily investing to see if it's a good vehicle to diversify your portfolio and help you accelerate achieving your retirement goals.